Welcome students to the series of lecture for CFA and FRM preparation. And today I'm covering a very complex topic, that is mean variance optimization. And this mean variance optimization is not only discussed in like FRM part 1, but also FRM part 1, part 2, CFA level 2, CFA level 3, and extensively discussed in FRM level 2 and CFA level 3. So this is one of the most complex discussion, I would say, mean variance optimization. So yes, mean variance optimization, it's not easy to understand if you haven't ever worked on optimization, solving any optimization function. But today I will try to explain this mean variance optimization in a very simple term. What is happening in this mean variance optimization, which is also called as return variance optimization. Okay. So we are trying to optimize something. We are trying to optimize something, and that something is your portfolio. Is your portfolio. So in mean variance optimization, we are trying to optimize a portfolio. When I say I want to optimize my portfolio, it means I'm trying to maximize the return of the portfolio. And at the same time, I'm trying to minimize the risk of the portfolio, right? You can also say in a very different term that you're trying to maximize the return for same level of risk. Return for same level of risk if you have a limited risk appetite. Or you can also say that you want to maximize your Sharpe ratio, which is simply return upon risk or excess return upon risk. So it is the portfolio optimization at the end. Portfolio optimization at the end is what? To maximize the utility of the person, the feel good factor of the person for their portfolio. What is utility? Utility is the feel good factor. Feel good factor, utility of the portfolio, which you do by maximizing the return and minimizing the risk, or you can simply say that you're trying to maximize the utility, and the formula for utility is given as return minus lambda upon 2 into risk square or variance. That's it. That's what you're trying to maximize in a mean variance optimization. That is the whole story. Now, when you're trying to maximize what you know, what are the inputs you're aware of the return of individual asset. You're aware of return of individual asset. You're aware of the standard deviation of the asset in the portfolio. You're aware of the correlation between the asset. So there are three inputs you're aware of. You're aware of individual asset return, you're aware of individual asset risk, and you're aware of the correlation between the asset. But you're not aware of what should be the weight given to individual asset in the portfolio, and that is what you're trying to find out with this maximization of utility function. So what you will do, you will take different weights. Say you start with weight like 0.02, 0.03, 0.04, 0.05, whatever, and you put that weight into this equation. This will give you a return. This will give you a risk. What is lambda? Lambda is a risk aversion parameter. What is lambda? Lambda is a risk aversion parameter. The scale of the lambda varies between 1 to 10. Okay. So if the risk aversion is 1, it means the person for whom you're trying to find the optimized portfolio, he is least risk averse. If the person is risk neutral, he doesn't care about risk, the lambda will be equal to 0. If the person is too risk averse, the lambda would be 10. Definitely the person who is risk neutral is not a rational investor, so we'll not talk about 0, lambda equal to 0, because the person is risk neutral. On an average, that portfolio manager sees that on an average, people have the lambda of 4. On an average, generally, the consensus between the portfolio manager is that investor has a lambda of 4. But that is a benchmark. A person can have more lambda or less lambda, depends upon what? The ability to take risk and the willingness to take risk. Ability to take risk is the person financial statement, the balance sheet of the person, the economic balance sheet of the person. The willingness to take risk is iksha, willingness of the person to take risk, right? Okay. So if you don't know how to optimize or you don't know how to do differentiation to find out what would be the tangent portfolio of this convex function, because this is a convex function, and if you try to find out the tangent of this convex function, that tangent will tell you the optimum portfolio. Assume you don't know how to plot the convex function. Assume you don't know how to find out the tangent. But what you know that you can assume different weights. You can assign different weights. So assume you took asset allocation one, you have given certain random weights. You got this return and this risk, right? You put down these values into what? This utility function, which is return minus lambda by 2 into the variance of that particular asset allocation, right? For example, this is 8% and this is 2.25%. I will put down 0.08 minus 4 upon 2 into 0.00225. And I will find what? I will find my utility, that is 3.5. I'll do this exercise for this as well. I will do this exercise for this as well. And I'll try to find out which asset allocation. What is asset allocation? Asset allocation is the weight given to the different asset in a portfolio. So this is asset allocation 1. This is asset allocation 2. This is asset allocation 3. So you decided, okay, you will invest in these assets. You're randomly choosing the weights and then you're trying to find out what utility for each asset allocation. Assume the utility for this came to 3.5, for this came to 3.5, for this it came to like 6. Which asset allocation you will choose as the final asset allocation, your strategic asset allocation? This one. This is the complete story of mean variance optimization. This is what is happening in mean variance optimization. You know the return, you know the risk, you know the correlation, and you try to find out the weights that you should be giving to your asset in the portfolio such that your portfolio should be optimized, which means it has the maximum utility, which means it has maximum return for the same level of risk. That's the complete story of mean variance optimization. But you cannot achieve mean variance optimization because in the world we have constraint. We have constraint. We cannot fully optimize any portfolio because we have constraint. The first basic constraint that any portfolio has to have is the sum of all the weights should be equal to 1. So when you try to optimize, this is a utility function. When you try to differentiate and find the tangent portfolio, try to optimize, then you have a constraint in that mathematical function. That constraint is the sum of weights should be equal to 1. This is constraint number 1. Now, a very general constraint that happens in this world is most of the portfolio in this world are a long only portfolio, not long and short portfolio. So the other constraints, general constraint is that the weight of each individual asset should be greater than 1. There are other constraints, and these constraints are required. For example, I'm giving you a constraint that any weight given to any asset in the portfolio should be less than 5%. Why? Because please understand, assume there is an asset in this portfolio. There are different asset, asset 1, asset 2, asset 3, asset 4. Assume asset 3 has a return of 15% and a risk of 1%. Other asset have lesser return and higher risk. Lesser return and higher risk because of some reason. This specific asset has the maximum Sharpe ratio. What will happen? This optimization, when you try to do this optimization in an optimization engine, then it will give 100% weight to which asset? Asset 3. And will assign 0 weight to asset 1, asset 2, asset 4. Because the whole objective of this optimization engine is to give you the maximum return and minimum risk. And that is only possible if you put all the money in this asset, which will lead to what? Concentration risk, right? Therefore, portfolio manager wisely put down the constraint that the weight should be less than 5%. Okay? Because why? Because this equation will always maximize the allocation to the asset with the highest Sharpe ratio or highest return for the same level of risk. This is the way this equation has been designed. There are other constraints in the world. You cannot give weight to tobacco, but ITC is one of the asset. You cannot have weight less than 10% in cash. This could be a constraint from the investor. These are investor TTLLU, investor based constraints. You cannot do anything about it. You're doing optimization for whom? For the investors, for your client. Okay, perfect. Now they are saying something very interesting, and they generally say this in the mean variance optimization, whether they are discussing it in FRM or CFA. They say that if you're optimizing or doing mean variance optimization and you have all the assets allowed to be invested, all the assets of the world allowed to be invested, then you don't need to do or perform any optimization exercise. You don't need to, because the efficient frontier itself is the most optimized portfolio, which was given by Harry Markowitz. Harry Markowitz efficient frontier and CAPM efficient frontier, which is given by Sharpe and Littner. But there are two division here of the efficient frontier. They say that if in the real world you don't have true risk-free asset, and most of the portfolio managers says that in the real world you don't have true risk-free asset. If you don't have true risk-free asset, you should use efficient frontier given by Harry Markowitz, and you can choose any one of the portfolio. Any one of the portfolio. But which portfolio to choose on this efficient frontier, that depends upon where the utility of the investor is getting maximized. And the utility function, I'm not getting into utility function, but if you see the utility function, it is again a concave curve. It is a concave curve. Okay, and it will be tangent at any given point in this efficient frontier, and that is your optimized or desired portfolio. That's it. In the case of CAPM, you have true risk-free asset. What we have, you have true risk-free asset. So actually, this is risk-free, and say it is say 0.01%. That is the risk-free rate. But there is a true risk-free asset. The return is very less, but there is a true risk-free asset. The tangent portfolio will give a tangency portfolio. And that tangency portfolio is your global portfolio. This is your global portfolio, global index. All the investable asset of this world is in this portfolio, global portfolio. And if you want to have your optimum portfolio, then these are the optimum portfolio. The tangent over the Harry Markowitz efficient frontier will give you a list of optimum portfolio. Now how you will choose your portfolio? You will design your utility function for the investor, and wherever it touches that point is your desired portfolio. So they are saying you don't have to do any optimization if you are allowed to invest in all the asset of the world. Start with what? Start with the tangent portfolio if you know the true risk-free asset, or you start with what? Harry Markowitz efficient frontier. Okay. That is what is being shown here. This is Harry Markowitz efficient frontier. This is the utility of the person. Where it touches, that becomes your optimum portfolio. So this is your tangent portfolios. This is your utility of the investor. Wherever it touches becomes your desired or final portfolio. Okay. And definitely the optimum portfolio will have the highest Sharpe ratio because it is coming out of CAPM efficient frontier or Harry Markowitz efficient frontier. It has to have the highest Sharpe ratio. Okay. After this, they generally talk about the criticism of mean variance optimization technique or method. They say that, first of all, it depends completely on what is your estimates or input quality. So you're throwing required rate of return of each asset, you're throwing standard deviation of each asset, you are calculating the covariance between two assets, and these are the input to the mean variance optimization, right? If these inputs are garbage, then the optimization engine will throw you garbage output, which is the weights which would be garbage. So they're saying, what are the inputs? What are the inputs in the mean variance optimization? The expected return, the variance of each asset, the covariance matrix of all the asset, risk aversion, and constraint, right? Mean variance optimization try to maximize the utility based on the constraint. At the end, it will throw what? Asset allocation. Asset allocation simply means the weights of different assets. And then you can back calculate what? The return, because that is weighted average, and you can calculate the risk. Okay, perfect. Now they are saying if you're throwing these inputs, these estimates as incorrect input, you will get incorrect value. So what is the fix? The fix is reverse optimization or Black-Litterman optimization. We'll discuss about it in a minute. The second, they say that generally mean variance optimization lead to high allocation or high concentration to the asset with the highest Sharpe ratio. And therefore the fix is what? You put down a constraint that weight cannot be greater than X%. That's it. The second thing, the second biggest problem of mean variance optimization is that it assumes normal distribution. First of all, it assumes normal distribution and it takes point estimate. Point estimate means that it is saying that I'm giving you only one value of the return of one asset, not multiple possible return for different probabilities. And then they give one estimate for standard deviation for one asset and assuming it to be normally distributed, and thus it does not account for different possibility of return, different possibility of risk, and it doesn't account for skewness and kurtosis because of this normal distribution assumption. So the fix is not written. The fix is Monte Carlo simulation or MVO through sampling or resampled MVO, which is simply Monte Carlo simulation. The third problem is it assumes one single estimate of return and risk. I just talked about it, that it estimate that the asset return would be 5%. That's it. It cannot be like 6%, 7%, 8%. It will be 5%. That is the mean return. Same for the risk, same for the correlation. But we all know that the expected return changes. We all know that correlation changes. We all know that risk forecast of a given asset changes, and it doesn't account for those changes or those distributions of return, risk, and correlation. So the fix again is Monte Carlo simulation or mean variance optimized resampled approach. We'll talk about it. The other biggest problem is if you're trying to find out the asset allocation for pension, you cannot use mean variance optimization because have you ever heard me talking about liability in the discussion of mean variance optimization? I'm saying asset return, asset risk. Did I say asset? Did I say liability return and liability risk? No. So it completely ignored liability, and pension funds are dependent upon maximizing what surplus, which is asset minus liability. So you cannot use mean variance optimization if you're trying to optimize liability driven portfolio management like pension. Okay. So definitely we talked about criticism. What is the solution? So first of all, what is the solution for garbage input? So garbage input can be converted into quality input with the help of reverse optimization and Black-Litterman approach. Both of them are almost similar. So I'll talk about first the reverse optimization technique. It says that instead of estimating return, covariance, and standard deviation of any asset, do not start from that. Start from your optimal portfolio. What is your optimal portfolio? Remember, efficient frontier, the tangency portfolio, that is the optimum portfolio, that is your global portfolio. So take your global market portfolio, right? What is a global market portfolio? A global index. Perfect. You can see the RA is known, the standard deviation is known, right? What do you need to do? You need to just back calculate the return and risk. And you also know the weights because you know what is your global market portfolio, constituents and their weights. So you can back calculate what? The return of each asset, right? Use those return for mean variance optimization. They haven't talked about standard deviation, but you also know standard deviation of the portfolio. Now you also know the return. You can also calculate the return of individual asset, right? Historical return and calculate the standard deviation and covariance. They haven't talked about it, but you can. right? Even in CFA level 3, they didn't talk about the mean variance optimization. Reverse mean variance optimization can be used to calculate the risk, but you can put those estimate of asset return and asset risk in this utility function. So you're not estimating the return. You are back calculating the return from which portfolio? The efficient frontier global market portfolio. So you're not estimating, you're not forecasting. You're using what is there in the market. Okay. So definitely this is going to solve your problem of throwing garbage input in the mean variance optimization. And these returns are called as implied return. And it is also saying that these return will also solve concentration issues in the mean variance optimization, because you will never ever find any asset which has a higher Sharpe ratio or a lower Sharpe ratio, because all those assets which are inefficient would not be on the efficient frontier of Harry Markowitz, so it will not be on the efficient frontier of CAPM. So therefore, the return that you're calculating, the implied return, is already respecting the diversification benefit. So you cannot have any estimate of any asset with the highest Sharpe ratio. So it also solves the issues of the concentration risk. That happens in the simple mean variance optimization approach. There is no difference between Black-Litterman and reverse optimization. It's the same thing. You back calculate what implied return. But the problem is sometimes these implied return does not respect the view of the portfolio manager, the view of the expert. No issues. Incorporate the view in the Black-Litterman approach. How come? For example, you calculated that global market equity through the reverse optimization technique, the implied return calculated is 7%. But expert has an opinion, no, it should have slightly higher return of 0.25%. That would be 7.25%. Or say that, assume the expert has a view that equity minus fixed income should have a gap of 3%. Global equity market and global fixed income market, or global equity asset of global fixed income asset, will have a difference of 3%. But what this engine, this reverse optimization, is throwing you 6% and 4%. No issues. Either adjust the fixed income return to 3%, or either increase the equity return to 7%. Or you can also make 6.5% and 3.5%. It is completely up to you, right? So adjust the expert opinion in these implied return. If you're not happy with the plain vanilla return given by the reverse optimization method, this method. Okay, that's it. Now, then they are saying how you can solve for GIGO and concentration other way than reverse optimization. Okay, you add some constraint. We discussed that assume there is a concentration risk, or assume you're not able to forecast the return and risk of alternative investment. You can simply add more constraint. Alternative investment is giving you a sense of high Sharpe ratio. But why? The reason is because these are smoothed return. These are smoothed return. And because of the smoothed return, it will give a false signal of high Sharpe ratio. High Sharpe ratio. What is Sharpe ratio? Return upon risk. Excess return upon risk is Sharpe ratio, because it underestimates the risk. So simply put down a constraint that the alternative cannot have weight more than 2%, more than 3%, because you're not sure about the inputs. And you can also resolve the problem of concentration. Okay. But remember, if you put down many constraints to your optimization engine, the optimization engine will never throw the perfect, fully optimized portfolio. So be very cognizant whatever the constraint you're throwing to mean variance optimization engine. Now, they're saying, how can you fix the issue of one single point estimate of individual asset return in the portfolio as an assumption in the mean variance optimization? Or how can you fix for the normal distribution assumption? Okay. To address this, they talked about resampled mean variance optimization. It solves for a lot of problem. It solves for single estimate. It solves for GIGO. It solves for concentration issues. It solves for a lot of problem. So they are saying Step one is you have to assume the return of individual asset, standard deviation of individual asset, correlation matrix or correlation of individual asset with other asset. You start with this. Okay. Now you calculate your mean variance optimization weight. Perfect. Now change this return from the normal distribution. This 5% would be at the center. Take different possible return of ITC. This is one return, this is second return, this is third return. Similarly, a standard deviation will have what? A right skewed F distribution or a right skewed chi-square distribution. Take different value of the standard deviation. Take the different value of the correlation matrix of the single asset. Do the same for other asset. So what you're doing, you're not taking one return, you're taking multiple return, you're taking multiple standard deviation, you're taking multiple correlation of that asset with other assets. You do this exercise for all the assets. Then take this combination, and generate the mean variance optimized asset allocation. This is your first run. Then take this return, this risk, this correlation, and this return, this risk, and this correlation. Generate second asset allocation as a different weight. Third, fourth, repeat this exercise for 10,000 times. And then take the average of each asset weight. This is the weight for ITC, this is the weight for Tata Steel. But there are 10,000 weights. Take the average. Use this final weights to create your strategic asset allocation. And it will help you resolve most of the problem of mean variance optimization. But the only problem is to run this Monte Carlo simulation, you need huge computation. You need huge computation power, or it will lead to huge computational cost. Nowadays it is simple, but yes, earlier it was costlier. Okay, then they are saying, but still it won't resolve the problem of skewness and kurtosis, because still what you said, assume return to be normally distributed. So they are saying, okay, let's take asymmetric distribution or take asymmetric risk measurement and return measurement. Definitely asymmetric return measurement, I have never heard of it, but we all have heard about asymmetric risk measurement. That is war at 95%. So instead of variance, which assumes symmetric distribution, use war. Okay. Now, sometimes the mean variance optimization has to be done not on the enterprise level, as in you don't have like big firm for which you do portfolio management. You also do portfolio management for individuals, HNIs, right? But there are some difference. The difference is individual portfolio behaves slightly different than institutional portfolio, because in individual portfolio you have human capital, you have real estate. So when you perform mean variance optimization, you have to respect human capital and real estate, because these are assets. What is human capital? In a very simple term, human capital is the present value of the income that you're going to generate. Now, if you have a stable job, then you can directly map it to inflation linked bond. Inflation linked bond, that is TIPS. Because you have a stable job, your earning will increase by what? Inflation. Then the second is, if you have unstable income, then you can map it to TIPS, you can map it to equity, and you can map it to corporate bond with a certain weight. And then you can throw that into mean variance optimization. How you decide the weight of these human capital? Because they are fixed. So you have to tell your mean variance optimization the weight is equal to current value upon portfolio weight, and that is a constraint. That is, you pass as a constraint. Similarly, you pass this as a constraint because real asset current value divided by the portfolio value will give you weight, and that is a constraint to your mean variance optimization. So you don't let mean variance optimization tell you about the human capital and real estate, because you already know that. So these are the constraint. Okay. Now, other problem with real estate is that how you will find the return, because yes, you have the current value. Yes, you have the portfolio value. So you can find out the weight, but how to find out the return? So they are simply saying, or simply say that use REIT, or is a very simple term, use index return. But you have to use the real estate index of that country only. investor, the individual's country only. You cannot choose US real estate index. Okay. So we talked about mean variance optimization. We talked about Black-Litterman and we talked about resampled mean variance optimization. With that, I'll pause here. Thank you. Have a nice day.